Most attorneys have adopted this and use it in their closings. And this is often what real estate agents need to submit to their brokerages with the check so they can get paid. Hey everybody, welcome to 2024. Here on the Real Estate Show, we figured this was the ideal time to get back to basics. So we are kicking off a series aptly named Back to Basics, where we get through, whether you're a listing agent or a buyer's agent, what you need to know about the relevant documents that your clients are going to be asked to sign, that you'll be preparing for them. And today we're starting with the listing side. So I'll be going over the seller CD and the Alta settlement statement so that you know what you're looking at and that you can feel more confident when explaining these numbers and these documents to your sellers. So let's dive right in. First, we're starting with the seller's closing disclosure. So this is the document, it's really short, that shows only the seller's side of the closing. It doesn't show the buyer's side. The Alta combined settlement statement, as the name suggests, is combined. It shows both sides. We'll get to that in just a minute. So what you're going to see on the first page of the closing disclosure is your closing date and your disbursement date. Now, those dates aren't always the same date. For example, let's say you've agreed on a closing date of, in this case, it was January 2nd, but the lender can't disperse until the 3rd. Well, then that's going to affect the date you sign is not necessarily the date that the funds will be dispersed. And that's going to affect your payoffs. It's going to affect prorations. So those numbers are not necessarily always the same. And it's important that you understand the difference, and that the disbursement date affects money. So anything that affects money is going to be controlled by that date. I have redacted these documents, so you're going to see a lot of blank spaces, but you'll see the file number if there is one from the closing attorneys. Most closing attorneys have a pretty simple file numbering system. You'll have the property address and sale price. You're going to want to make sure all of that is accurate. And then transaction information, you're going to identify the other parties, so who your buyer, your seller, and the lender for the buyer is. Now, on the summary of transaction, Section M of seller's transaction is due to seller at closing. So what I like to call this is what the seller is owed. In this case, for the transaction that we're looking at, was the sale price of the property. If there were any, personal property items that were included in the sale, that would have been here. If the seller had prepaid 2024 taxes, which is not possible because the bill is not out yet. But let's say the taxes were out and the seller had already paid them, then the buyer would reimburse the seller accordingly. Same thing on HOA dues. So say the seller had already paid HOA dues for this property through the first quarter of 2024, then this is where the buyer would be reimbursing them for the buyer's portion of whatever had been prepaid. Now, Section N is the opposite of that. It's what the seller owes. Section M, what the seller is owed. Section N, what the seller owes. Line 1 is rarely ever used. Line 2, it refers to the closing costs that the seller will pay at closing. Now, this is a summary line. It gets broken down further on the next page. We'll look at that in just a second. But this is the high level of all of the closing costs that the seller will pay that are not identified on this page 1. Next, on this particular closing, the seller had a payoff, so they had a loan on the property that had to be paid off to the lender at closing, and they just had one. So there is a payoff of the first mortgage loan to, we've hidden who that lender was, so there wouldn't be any identifying information, but this is what the seller owed on that property. That includes principal, interest. Most payoff lenders are going to add a couple extra days of interest so that there won't be any shortage. This is to the seller's benefit because they're going to get refunded anything that was overpaid. And also, if the payoff is short, then the seller still has to get that paid off and provide clear title to the buyer. And it's just another thing to have to clean up post-closing. So having all of that handled in the payoff, it's much more convenient to buyer and to seller to get a refund rather than be chasing someone down to pay money that they didn't have enough for. Next, since there wasn't a second mortgage loan, there's not going to be a payoff listed there. If there was a seller credit negotiated, this would be something that seller owes. So it would go in this section and be listed here for something that the buyer would get credit for, and it would reduce the amount that the seller would take home. And then the due diligence fee, sometimes people don't understand this, is why is the due diligence fee credited to the buyer at closing? And that's because it was money already paid to the seller and should have been cashed and deposited by the seller. So if that's not given as a credit on the closing statement and the buyer has to basically bring another $2,000 like it was in this instance, then it's like the buyer is paying, or it's not like the buyer would be paying the due diligence fee twice. So because that money has already been paid and it's applicable to the purchase price, then it is reduced from what seller receives at closing. So next thing, taxes. Because we're in a new calendar year, this is another thing people don't understand often, is that taxes are paid on a calendar year basis, not a fiscal year basis. 2024 tax bills have not come out yet. They'll come out later in the year, and they will cover the entire 2024 calendar year, not June or July to June or whatever the county's fiscal year is. It is a calendar year. So because the buyer of this property will be responsible to pay the tax bill in full when it comes out, the seller is giving the buyer credit for their portion of 2024's taxes. Now, this particular closing occurred on January 2nd, so they had a very small portion of the bill. So they're just paying their small portion of 2024. Because the buyer received credit for it on the closing statement, then the seller will be done with the tax bill as of this closing, and the buyer will remit that in full. Or most likely, since there's a lender involved, the buyer's lender will remit that out of the buyer's escrow account. So this calculation at the bottom is taking section M, what the seller is owed, and deducting section N, what the seller owes, and that cash to close to seller resulted in that bottom line number. So that's what the seller should expect to receive in a wire or a check, whichever they choose from the closing attorney. Now, it is possible that you might wonder, why is there even a box to check from seller? If in the event this first mortgage loan was more and, say the sale price was $300, but the mortgage loan was $290, and there were these other costs, that meant that what they owed was more than what they were receiving, then they would have to bring money to be able to satisfy all those obligations. And the closing could not occur or be recorded till the seller had paid that money into the closing attorney. So that's why that's even an option. And then on the right side of this page is just straightforward contact information for both agents and the closing attorney. Now, this next page that we're looking at, the closing cost details, I mentioned to you that on section N, line 2, the summary line of the closing costs would be broken down. Well, this is where that happens. In section A of the closing cost details, A, B, and C are borrower charges, so you're not going to see anything there unless the seller paid specific borrower charges. Say they bought the rate down for the buyer, then you would see that in section A. Whether they did that before closing or at closing. So really just any of the specific buyer charges that the seller paid for. Often that's just negotiated as a credit, which you would only see on the first page. But if it was, we will pay X amount to your rate to buy down your rate, then you would see that in the top half of this page. Most often you're not going to. Now, if you're listening to this on the audio version, I'm going over the actual disclosure on the video version. So you may want to go back and listen to that or switch over if you're able to watch. But if you're listening to this on the audio version, grab any closing disclosure from a recent closing of yours, and then you'll be able to follow along exactly what I'm saying here. Section E, in North Carolina, we have something called excise tax, sometimes called revenue stamps or deed stamps, depending on, how you grew up learning the term. But this number is $2 per every 1,000 of the sale price is assessed to typically is assessed to the seller whenever you sell property. The parties can negotiate for the buyer to pay that, but it is non-typical. So it would have to be specifically negotiated for buyer to pay that. Otherwise, it is a seller charge. So another way to do that math, if it's easier for you to understand, is take your sale price and divide by 500, and the number that you get is what you'll be paying in your excise tax. So that's what you see in Section E. If there were any other documents that the seller specifically needed recorded, for example, say they're signing with a power of attorney, that document has to be recorded, and the recording charges will be listed here. Section F, and G, there's typically not anything listed there for a seller because those are buyer things. They're, setting up your escrow account, prepaying your homeowner's insurance, etc. But Section H is kind of everything else. So you'll see commissions here. If you are having an attorney prepare your documents, which you should, then those document preparation charges will be listed there, whether it's the closing attorney or you have a separate attorney. So whatever invoices you need to pay, say you're paying somebody for repairs that were done, and they have to be settled up prior to closing, that can be listed here. There's really all kinds of stuff. If it wasn't identified in a prior section, Section H is where you're going to see it. So that's usually where the most of the charges come from that build up that summary line of the closing costs. Again, main things you'll see: document preparation, commissions, invoices. So whether that's home warranty, repairs, things like that. And then the last part of the seller's closing disclosure is the signature page, and that's been entirely redacted. So you can't even see, you're not supposed to be able to see who's signing it in this particular document because it's not your closing. But that's the acknowledgement page, just confirming that the seller has reviewed that document. So moving on to the ALTA Combined Settlement Statement. ALTA refers to the American Land Title Association. So they're the association that came up with this form, and they promulgated it and they put it out. And, most attorneys have adopted this and use it in their closings. And this is often what real estate agents need to submit to their brokerages with the check so they can get paid. So this one you're probably more interested in. But in this case, if we're talking about listing agent stuff, you're looking at the left side of that ALTA Combined Settlement Statement in the debits and credits column to be able to explain to your client what this stuff means, and also make sure for yourself that the information is accurate. Some agents are tempted to say, well, the attorney prepared it, so that it should be right. That is true, but also we only create the document based off inputs. So we don't whip up numbers out of thin air. So you should make sure that every charge that needs to be accounted for here is on here. And if not, then provide the document to the attorney. A lot of times that closing table will be told, we actually have an invoice that needs to be added to this. And that could throw a big wrench into the closing or delay it if we're not notified in a timely manner. So that's why it's important that when you get this, you look at it and make sure everything that needs to be paid, including you, is listed here. So on the seller side, in the credits column, you're going to see the sale price of the property. In this case, for this particular closing, this is a different closing than the one that we looked at on the seller CD. So I wanted to show you a slightly different way this could play out. So that's why the numbers are different. But sale price of the property, this case, the seller did give a credit. So that credit is in the debit column on the seller. You'll see it in the credit column on the buyer, but again, we're focused on the seller side of this. Here in the prorations and adjustments section, this is something you don't see every day. In this particular sale, the sellers were getting divorced, so they'd agreed to split the proceeds a certain way. So those sale proceeds are itemized payable to each person on the closing statement. And because of that, there's not we'll see it on the next page, there's not going to be a due to seller because they're not together receiving that lump sum amount. So we have to itemize it out based on who's getting exactly what. Next, in this case, this was a closing from last year. that closed towards the end of January. So taxes, again, not out yet for 2023 at the time of this closing. So the seller was giving the buyer credit for the tax bill since the buyer would be paying it in full later that year. The due diligence fee being paid or being credited since the buyer had paid that at the beginning of the process. This also had an interesting scenario where between the parties, one of the parties had borrowed money from a parent for the house, but that parent didn't take a deed of trust on the house, but the parties had agreed to pay that amount at the closing. So as long as it's agreed upon by the parties, that can be done. And in this case, it was. So there's a specific amount of money being paid to one of the parties so that the parent could be paid off. And then next, the seller had already paid HOA dues on this property for the whole first half of the year. So from January 1st to June 30th, which meant that the buyer needed to refund the seller for the buyer's portion of that. So of course, seller is responsible for the HOA dues for every day that they own the property. But once the buyer took over, then they needed to reimburse seller, and that happened here. Their next chunk, the loan charges and impounds is another way to say escrow, by the way. Those are all for the buyer. So we're going to gloss over that for now because that is not something that's relevant to the seller's bottom line. Payoffs and payments. In this case, the seller did have one loan that was secured by a deed of trust to be paid off. So you've got your payoff here. And the payoff works the same way as we talked about on the closing disclosure. That'll include principal, interest, all of those things. Now, next page here, you've got your excise tax, which we just talked about how to calculate and how you can explain that to your seller. And this closing is different. It does have a document that needed to be recorded. In this case, it was a separation agreement, and it had some relevant information in there that needed to be on record for the purposes of conveying clear title. So the sellers are paying for the recording of that document. Commissions being paid to the listing and selling agent underneath the commission section, and then in miscellaneous charges, this reminds me, if the HOA dues were due before the closing but had not been paid. That's what happened in this situation. The HOA dues were due and payable but hadn't been paid. So the seller is remitting the payment, but buyer is reimbursing seller for the buyer's portion. So that, as long as it's prorated, then you can it just depends on the closing attorney system or how the HOA requires it to be done. So if the HOA won't accept partial check from seller and partial check from buyer, then the owner of the property at the time the bill was due is going to pay it in full, and then buyer just reimburses them. And then here, since there was a payoff, as closing attorney, there was a fee to cancel that loan. So that fee is being accounted for here. So under subtotals, you're going to see the seller side, the credits and debits. The due to seller is going to be 0 here, again, because on that prior page, the sale proceeds were listed out separate because it was a divorce situation. So if this is, if you're a listing agent and you've got a scenario like this, you'll be directing your clients to their specific sale proceeds line so that they can see what they will receive once the deed has recorded. All right, so last page is that signature addendum where it's saying, the parties have reviewed the settlement statement. They believed it to be accurate. And, we authorize the funds to be dispersed in accordance with the way this document is laid out. So it's really important that, you go over this with your clients. I know at least in our office, we endeavor to get this out as early as we can when it's accurate. So if we give you, if you want the document 3 weeks in advance and we don't have all of the information in, we don't have the payoff, then that document's not going to be very meaningful to you. But as soon as we have an accurate document in hand that we believe is complete based on all the information that we need, we endeavor to get that out to the agents as quickly as possible. And that's so that we can catch things, or, you can submit invoices that perhaps you'd forgotten to send in the hustle and bustle. But again, we can only do that once we have the information in. So if we're waiting on a payoff or HOAs to come in, then it's going to be difficult to send out an accurate statement. And as you know, once your clients get a number in their head, even if they've been warned this one's not final, then it's really harder. It's harder to explain to them why they're getting less money than the number they saw before. So, that's kind of the goal is as soon as we get something accurate, we want it out and in your hands. Please look at it before you get to the closing table. As a closing attorney, I can say 9 times out of 10, it is very obvious when the agent has gone over these statements with their clients before they get to the table. They are way more relaxed, a lot less on edge. They feel like they have a good grasp of what's going on. And they also look at their agent as much more of an authority. And when the agent's had this and is like, I don't really, I can't really go over all this. I don't really understand all this. Then they lose some of that authority at the table. And then, of course, that's where I'm willing to step in and make sure people understand things. But it can kind of diminish the relationship. So being able to go over this very well with your clients, I observe that it strengthens that relationship between seller and listing agent significantly. So there is my soapbox, whatever you want to call it, about the seller side of the closing disclosure and settlement statement. Now, hopefully this stuff is not new to you, but like I said, we're doing back to basics. So we want to all get extremely good at the basics. Let's not let anybody do it better than we do, right? And because that is going to set you apart. When you do the basics extremely well, then you're more likely to be able to do the complicated stuff really well. All right, so thanks for joining us on The Real Estate Show. We'll catch you in the next episode.